Retirement is a hot button topic for many, in particular the baby boomer generation as well as Gen X. Now, they paid into the system, they saved their money, and they invested in their 401k and made reasonable financial decisions that have carried them to this point. Now it's time to position themselves for retirement. But how should they go about it? In today's video, we're going to be tackling that issue for our client, Kevin. Now, Kevin is a 60-year-old male, and he works as a part-time electrical contractor. Now, he does have a decent amount of assets that he's positioned for himself for his upcoming retirement. Let's take a look at his basic financials. Now, Kevin owns his primary residence. It's mostly paid off 30-year mortgage. He does have a small outside brokerage account, about $70,000. He has two single-family rental properties valued at around $600,000, mostly paid off, and he collects some rental income from them. And he has his $440,000 traditional IRA. Now, at the moment, Kevin mentioned to us that he's working with a fiduciary who helps manage his IRA and general investment portfolio. Everything looks good on the surface, but for him, he's not quite satisfied. His current portfolio does around 6.8% annually with a 1% annual asset under management fee, so net somewhere around 5.8 to 6% annual returns averaged out. When it comes to his upcoming retirement, he's left with a bit of dilemma because if we apply the classic 4% rule to his distributions on his $440,000 IRA, it brings us to about $17,600 in annual income. Also, because it's an after-tax retirement account, his net of tax is closer to $12,000 to $14,000 a year, or a little over $1,000 a month. Even if we account for some more growth between now and his planned distributions at around age 70 to 71, it's still a little too light an income. That said, our client Kevin is a frugal shopper and a fairly savvy investor. He wants to position himself for the best possible strategy. He wants assurances and guarantees. He also wants to set his family up for a good inheritance and give himself the best possible chance for success in retirement, for income, as well as wealth preservation. So let's summarize what Kevin is looking for. For one, he wants to position his $440,000 IRA in the most effective and efficient way possible without having to touch his other investments. Now, he is okay with exposure to the stock market as long as his risk to capital is low. Two, he wants guaranteed income that he can live on when he reaches 70 years old plus without reducing his lifestyle too much. And three, he wants to give back to the next generation in the form of decent sized inheritance, in particular to his two granddaughters. Four, he came to us because he likes the infinite banking concept, particularly as a tax-free compounding cash reserve aspect, but every agent he talks to gives him too little cash value. And lastly, and most importantly, he doesn't want to run out of money in retirement. If this laundry list of needs in retirement resonate with you, then stick with us because we're going to dive into some actual numbers and show that Kevin can in fact have his cake and eat it too. So let's get at it. By the way, in case we haven't met, my name is Joseph Gutierrez, and this is Covered and Compounding. Click like and subscribe to learn how we use high cash value life insurance as the foundational asset to build our wealth over the long run. Now, to answer how we can help our client accomplish his goals, let's first go over what product it may not be the best fit for Kevin. For one, an index universal life policy, in our opinion, is not the right fit for Kevin. Now, if you've seen our short series, Profiting with Index Universal Life, we went over concepts and design considerations and examples. Where IUL shines is with individuals who have years of contributions to make towards their policies, letting average 6 to 8.5% compound interest work over the long run. When designed correctly, we get the opportunity to grow with the market in a tax-deferred manner while reducing our costs. We then have the option of taking tax-free income via policy loans in retirement if we want, loans that we don't actually have to pay back. As long as the client is good with the variable nature of the market, the IUL will work great over the long run. That said, Kevin doesn't have 40, 30, or 20 years to get ready for retirement. He has about 10. We also have to keep out an eye for that ART cost as well as in our design to avoid unnecessary future costs. That and the IUL doesn't have any guarantees usually. Remember, guarantees are a major item for Kevin's laundry list for retirement. So although the IUL is a great product that I actually use myself, it's not the best fit for Kevin. So what is? Well, the answer is actually a two-parter. First, we're going to make use of an optimally designed whole life policy for cash value and heightened level death benefit. In this way, he can have a large death benefit day one and build cash value quickly while reducing his costs over the life of the policy. The main thing for Kevin is he doesn't want his premium dollars to disappear. He wants access to it along with some good tax-free growth. Basically, a high yield savings account that can be there if he needs it. Now, this covers item number 2 and 4 of Kevin's laundry list, and we'll get into some detail in that in just a moment. For his income, he'll make use of an annuity with a guaranteed income rider component. Now, the annuity will give him that income guaranteed for the rest of his life. Even if his original account balance drops all the way down to zero, he will still get that income check. This is the beauty of the annuity because it provides assurances if we live too long. Now, this covers items 3 and 5 of his laundry list for retirement. And lastly, to address item number 1 of his list, we will maximize efficiency. By utilizing both products, we will show how we can use one to fund the other, stretching out his dollars in retirement and giving him the guarantees that he's looking for. So let's jump in and take a look at the strategy. So how do we accomplish this? Well, we're going to make use of 2 insurance carriers. On the life insurance side, we're going to be utilizing the L95 Guardian Whole Life policy, a blended design for maximum cash value accumulation. That's his infinite bank. While on the annuity side, we'll make use of the Allianz Benefit Control Plus fixed index annuity. We'll fund both with that $440,000 IRA. Now, in the base funding year, we'll disperse $40,000 from that IRA to fund the whole life policy. Of that $40,000, we'll withhold about 20% for taxes, so our total annual premium will be about $32,000. The remaining $400,000 will be rolled over into the annuity. That's the base year one. Going forward, because we want to grow our infinite bank of our whole life policy in a cost-effective way, in years 2 through 5, we'll disperse 10%, or in this case, $40,000 from our annuity penalty-free. In year 6 plus, we'll stop manual distributions from the annuity and let the annuity maximize its accumulation phase. In the 11th year, when Kevin plans to fully retire, we'll then turn on the lifetime income stream for his retirement. What we'll see next is how both products grow our wealth in different ways and provide the estate planning and retirement income that we can only find through life insurance products. So let's go ahead and take a look at some of the numbers. Okay, so now that we have a pretty good understanding of the concept and how we're going to be utilizing a whole life policy and an annuity to accomplish Kevin's goals for his retirement and estate planning, let's go ahead and focus in on some of the numbers and look at each individual policy and how we can accomplish our goals. Okay, so we're going to focus in here on the whole life policy first. So this whole life policy is through Guardian. We'll look at a policy summary or an illustration. Okay, so first, right off the bat, we have our client here, age 60, non-smoker, so standard health rating here, non-tobacco. Okay, so we have our policy summary sheet. Okay, so when we talk about putting together a maximized policy or an infinite bank, what we're really saying is we want to have our cash value as accessible and as much cash value in early years and in later years as possible. Okay, so standard whole life policies, unfortunately, do not grow cash value very well. We'll see a bunch of zeros of cash value in the early years, and it catches up, year 15, year 20. And unfortunately, many agents will put their interest ahead of their clients because the commission is higher for a high base policy. So for when we look at our client here, he wants a $500,000 whole life policy. If we put together a $500,000 base whole life policy on its own here, the premium is going to be very expensive. We're going to have very little cash value, which is not what he wants. Okay, so the better way to do this, if we're going to utilize a couple different riders. Now, if you've seen some of our videos in the past where we talk about putting together infinite banks and how to put it and how different policy design considerations are made, feel free to check out some of those videos, but we'll kind of go over just like a brief overview, okay? Brief refresher. So when we have our participating whole life policy, in this case through Guardian, we have three different concepts here. We have the base, so the base of the contract, okay, base premium, the premium that goes towards the base face amount. So in this case, $100,000. We have our term rider, in this case called OYT. Sometimes it's called annual renewable term. Okay, so that's the term rider that gets added on top of the base. And then we have the paid up additions, or also known as PUAs. Okay, paid up additions basically are little mini whole life policy that are tacked on top of the base of the policy. So the reason why we incorporate all these different riders is because we are able to reduce our costs and increase our cash value, which is the name of the game here. Okay, so right off the bat, we see that we have $100,000 base, but we have a total of $500,000 of total death benefits. So we know that we have $100,000 base, and our term insurance, or OYT, is $400,000 OYT that gets tacked on. So God forbid something were to happen to Kevin in the first, second year, whatever, his family would get access to $500,000 tax-free as an inheritance check. Okay, so briefly, to refresh our memory here on infinite banking, okay, a lot of agents kind of gloss over this, but we always like to educate our clients, right? Think of the policy as a glass sitting on top of a coaster. Just for illustrative purposes, just roll with me here. So the coaster symbolizes the $100,000 base, and we have this empty glass. The empty glass symbolizes the term insurance. So the term insurance of $400,000. Okay, so great. So as we take our water and we pour it into the glass, it fills up the glass and it removes the empty portion of the glass. So as we go ahead and start filling up the glass year after year, the filling up of the glass with water symbolizes the PUAs, okay, and which we'll see here shortly. So every time we add PUAs, we reduce the required amount of term insurance. Now, the reason we do this is because every year that goes by, the cost of the term insurance recalculates. And the older we are, the more aggressive the recalculation is, the more cost is. So we want to burn off that term insurance rider as quickly as possible, or at least in an efficient manner, okay? So let's say our PUAs buys $50,000 at the end of year one, $50,000 towards the PUAs. So now we have our base of $100,000. We have $50,000 of PUAs, which leaves a remaining only $350,000 requirement of that term insurance rider, okay? That term. Okay, fantastic. So in doing so, we're able to increase our cash value in a more efficient manner. Okay, so now we have this kind of the basic terminology here out of the way. We can see here on this summary sheet, and we're going to dive into some of the numbers a little bit deeper, but we can see in our summary sheet here that we have we have $32,000 that are going into the policy every year. That's that $40,000 that's coming from our Kevin's IRA in the first year. Of that $40,000, we're going to save 20% for taxes. $32,000 is going to be the net premium outlay. And we can see that our net cash value in that first year is $25,844. And we have our death benefit of $500,000. What's great about setting up a policy in the correct way is that we have our break-even point in the earliest year possible. So as we can see here, we've funded our policy $32,000 every year for 5 years. Our net outlay into the policy is $160,000, and our total cash value at our 5th year is projected to be $158,819. So almost break even at the end of that 5th year. Okay, if we had an all-base policy, we wouldn't see numbers anywhere close to this. Okay, and the reason why we do this, we want to maximize that cash value and maximize our infinite bank. Our client Kevin here wants access to his cash value in case he needs it. He doesn't want his premium dollars to disappear, and this is how we can accomplish that. Let's go ahead and scroll on down to the portion of the policy that kind of shows the breakdown. Okay, right here. So we can see kind of the breakdown a little bit better. We can see our $100,000 that cost for the L95 for our client here is $4,890 of that $32,000 total premium he's putting in for the first 5 years. We can see in the first year that the OYT is $714.45, and that increases and changes year after year. But we can see that the cost of that insurance, that term rider, is fairly low. So we want to kind of burn off that term rider as fast as possible. All the additional premium here, so this $27,110 minus the OYT, that goes into cash value. So when we look at this ledger, we can see here that of that $27,100 in our first year, we can see $25,682 shows up as cash value. That's that efficiency of the PUAs. About 95% of it shows up as cash value year 1. And it's fully paid up, so there is no more future contributions to that particular PUA, which allows us to have all that cash value. We also see that our face amount of that PUA has risen to $48,056. And then when we look at the next column, which is this OYT, remember it started out as a $400,000, it decreased by $48,000. So now our OYT is $351,000 plus here. Okay, so every year that goes by, as we make contributions, especially towards PUAs, we see our required amount of term insurance go down. Okay, and we also see our net cash value stay relatively high as well. So in our, looks like here, our 6th year, that's when we see the break-even point, okay, just after that 5th year, right? We also see something kind of interesting. After our 5th year, we're not making any more larger contributions to our policy. We're just doing the base premium. So in this case, about $4,890. We see still that our OYT amount that's required to reach that $500,000 is going down. But we're not putting any money towards the term insurance rider or the paid up additions rider. So why is that? Well, remember, with these types of policies, these are participating whole life carriers, they have a dividend that comes in every year. And in 2025, for Guardian, we're looking at a 6.1% dividend. Okay, so based on our cash value and death benefit and a lot of different factors. So that 6.1% dividend automatically, at least the way we set it up, goes towards PUAs, which buys down the remaining term insurance and increases our cash value. Another fun little fact here that I think gets glossed over a little bit. Let's look at year 6. We look at year 6, we're putting in $4,890 towards our policy, but we see our cash value, it grew about $10,000, went from $158 to about $168, okay? So what's nice is that we're kind of doubling our money in a tax-free manner, tax-deferred manner, So our cash value is growing very aggressively and buying down this term insurance to about the 85th, 86th year. All the way, and once we get down to these numbers here, we can see our death benefit actually start to climb because now our cash value has caught up with the death benefit, and that OYT has been extinguished. The other important thing to note is that our client can access his cash value whenever he wants. Okay, and the nice thing about it is that the dividend rate, or excuse me, the loan rate is about 5%. And depending on the age of the client and how many years the client has had the policy, it can actually drop down to 5.3%, or excuse me, 3.5% on their loan value. Meanwhile, we have a 6% dividend rate that's associated with this type of policy. And the only way to really see that, we have to do an enforced illustration, and this is for this type of policy. But nonetheless, the policies are designed to be the most beneficial in later years. Now, luckily for our client here, this cash value, although nice to have in his back pocket, most likely won't be necessary because we're taking care of his needs for retirement income with his annuity. And his annuity does give us a considerable amount of increased, stepped up retirement income every year. And we'll see that here next. Okay, so now that we have a good understanding of the whole life side, let's go ahead and look at the annuity side. That's where we're going to get that guaranteed income. And what's nice about this particular product is that we get that nice step up in income. So every year, every time the market does well, it credits us and we can possibly get even better and better income as we age. Okay, so we'll come on here. We're going to focus in here. We're going to be looking at Allianz Life, one of our A+ carriers for fixed indexed annuities. And we're going to be focusing here on the Allianz Benefit Control Plus annuity. Now, we did do a video on this, one of our previous videos on the Allianz Benefit Control Plus annuity. So refer to that annuity for more detail. We're going to kind of speed through it a little bit here so we can kind of get to the meat and potatoes of the numbers here and how our client here can maximize his retirement. Okay, so a 60-year-old male, he's moving over that $400,000, and these funds are going to be utilized to fund his whole life policy as well as give him that guaranteed income. Okay, so we have increased income potential. Okay, we talked about this in our previous video, and we're going to start our income in year 11. Okay, what we're also doing here is we're actually taking income years 2 through 5. Okay, so the first year, remember, we took the income directly from the IRA, and in years 2 through 5, we're taking that $40,000 from the annuity itself. And we're able to get those distributions because if we scroll back up here, we can read this right here. Right here at the penalty, the free partial withdrawal. Okay, in contract years following any contract year in which premium is paid before we take annuity payments, we can take up to 10% of the accumulation value or the total premium, whichever is greater. Okay, so we can pull out that $40,000 or 10% of the $400,000 every year, no matter what. Great, and that's all penalty free. Okay, so remember, when we look at this, the definitions and key terms, we're utilizing the accelerated PIV interest bonus. Remember, in our last video, we talked about how the PIV bucket there is our income bucket, which derives our lifetime income. And if we can maximize it and give the strongest bonus possible, we can, during our deferral years especially, we can build our retirement income much more than if we were to take income day one, okay? And that's the whole point. And that's one of the benefits of utilizing a fixed index annuity, because we do have that free withdrawal feature, so we don't have to turn on our income switch immediately. Because if we do turn on our income switch immediately, we greatly reduce our potential gains, and we kind of lock ourselves in on reduced retirement checks, which we don't want to do necessarily. Now, if the client or the individual is very hands off from the market, they don't want anything to do with the stock market, then one of those kind of guaranteed roll-up type products would be okay for them. But if we want to maximize, we really should look at a product like this. So we're going to go ahead and scroll on down here. Okay, we have our accelerated PIV, and we're utilizing two different strategies, 50% allocation per. Okay, we're going to be utilizing the 2-year, those call option durations here, and we see our participation rates of 95% participation rate for the Morgan Stanley, and we're utilizing the SP futures 60% participation rate. Now, remember, in the fixed index annuity world, we have the gain in the index times the participation rate times whatever PIV multiplier we have. So our PIV multiplier here is 250%. So as long as we're above 0, we're going to get a sizable increase in our PIV value, which is what we want. That's what our income is derived from. Okay, so when we see these participation rates being underneath 100%, we also have to factor in and we have to multiply that final product by 250% or 2.5. Okay, and we'll see that here in just a moment. Moving on down, let's go ahead and look at some of the numbers. Okay, so pretty straightforward here. We've got our $400,000 and we're pulling out $40,000 every year, years 2 through 5, and then we stop. Okay, so right off the bat, we see our end year accumulation value does show that we are coming down as far as our available accumulation. That said, because we are indexed to these great index strategies here, we are getting superb returns here. We have 9%, 15%, 35% on the underlying index after participation rate. We see on our protected income value, we see these huge numbers here of 22% gain, 38% gain, and so on, an 88% gain on our money. So what that does, it allows us to pull out that $40,000, but keeps our potential high on our protected income value, or our income bucket, if you will. Okay, so that by the time the 11th year comes by, and we say we're going to take out income, Kevin's going to take out income, well, we still grew our protected income value from $500,000 all the way to over $1.6 million. Okay, and then when we incorporate our disbursement here, our payout percentage, we get our first starting year based on this hypothetical, right? The last 10 years being applied to the next 10 years, which gives us just a roadmap. But remember, it's hypothetical, but we're projected, at least in this hypothetical scenario, of $87,000 of income in that year. And then every 2 years, as long as our indexes do well, we see a step up in income from 87,000, 98,000, 122, 187, and so on and so on and so on. So we can see how our client, he has his infinite bank, he has his cash value, which is nice to have because he wants that large death benefit, but he also wants to have access to his cash value, the amount of premium he's put into the policy. But once we get to our later years here, we're not really going to need that cash value necessarily because we have this very strong income every year that goes by. And if we were to kind of go all the way, let's say Kevin lives a long, happy, healthy life, and he makes it all the way to his 89th and 90th year, he's going to be receiving $590,000 a year, hypothetically, in this example, assuming that the next 10 years kind of replicates the next, or the last 10 years replicates the next 30 years to a certain extent. he could potentially be receiving on the order of $590,000 a year. And if we look back at our whole life illustration, 30 years from now, he's going to have a death benefit of $569,000 and a sizable amount of cash value as well. Okay, so we can see how we covered our bases here for our client, Kevin, how we're able to grow his accessible retirement income during that 10-year deferral period by maximizing it, and that we can even take money out of the annuity, which in most other annuities would depress the potential income significantly. But because we're utilizing this product with Allianz, we have these fantastic gains, these different strategies that allow us to build our cash value, or excuse me, our protected income bucket so well that it really doesn't matter that much. So we're able to maximize our future retirement income much more than we could have with just some general brokerage account or managed account, and have a sizable death benefit for our beneficiaries that obviously get paid out tax-free. Thank you for watching our video. In today's video, we looked at our client Kevin's retirement planning strategy, how he's able to maximize both his annuity and his whole life policy. On the whole life policy side, we utilize an infinite bank with Guardian Life, the L95 product, where all of his premium put into the policy was accessible in early years and kept accumulating in a tax deferred. He could access it tax-free. And on the annuity side, we utilized actually by taking disbursement in the early years of the annuity to feed the whole life policy, all the while still growing our protected income value, which allowed us to get increased payouts in retirement. When we do turn on that retirement switch there and give ourselves income, in this case, our client can give himself income, we can get heightened payouts that we can't necessarily get in any other way with any other product. These two products we looked at were Guardian Life and Allianz Life, and we paired them together to maximize our clients' needs. If this interests you, or if you're looking to put together your own whole life, index universal life, or annuity type policy and would like our help, feel free to check out the link in the description. It'll take you to our webpage where you can book a free online consultation. Okay, thank you for watching again, and I look forward to seeing you on our journey towards financial independence utilizing the foundational asset. Until next time.